Hey guys, Tony here. Welcome back. In this video, we're talking GameStop in light of their recent Q3 earnings. I want to give you my thoughts on the financial statements, how the company performed, where I think the price is headed, and what all those analysts are saying. We're going to talk about Ryan Cohen being able to trade on GameStop's cash position, and we'll talk about, finally, does GameStop have a chance to get in the S&P 500? Let's get right into it. In this video, I'm going to give you my non-hype, very realistic financial analysis of GameStop. This is my DD that I'm sharing with you. Not all of you are going to agree with it. That is cool. Always do your own due diligence and feel free to share your comments down below, your questions, whether you agree with me or disagree. 3 months ago, I did my last update for GameStop. It was trading at $18 and change. I told you that I had a $10 price target for GameStop. It subsequently traded all the way down to $11.80. So we didn't quite hit 10 bucks before the earnings. Now that we have those Q3 earnings and we see exactly what was on them, and we're about to head into the best quarter of the year for GameStop, Q4, let's talk about what I think is going to happen next. GameStop had mixed results for Q3. Analysts were expecting about $1.18 billion in top-line revenue. It came in at $1.078 billion, so a slight miss on the top-line revenue, but they beat on earnings. So net loss was only $3.1 million, giving them a net loss on the income statement of 1 penny per share. Analysts had been expecting negative 8 cents per share, so that is quite a beat on the earnings, even though it was still a loss. And even though they booked a loss for the quarter of $3 million, that is still a heck of an improvement from the same quarter a year ago, where they lost $94.7 million. So hat tip to GameStop for tightening up the hatches and getting those costs under control. Looking at the financial statements very quickly at a high level, revenue $1.078 billion, the cost of that revenue $796 million, yielding a gross profit of $281 million. That gives them a gross operating margin of 26%. And if we go down to the bottom of the table here and look at the history of the gross margin, you can see that they have been making steady improvements at increasing that gross margin. How are they doing that? What is in cost of revenue? How did they drop it so much? You guys have heard about all of the layoffs, the layers of management in the stores that they've been cutting. All of that direct labor cost goes directly into this cost of revenue. And so even though it is inconvenient to employees and it is causing a lot of frustration at the staff level in the stores because they don't have all of the managers that they want, they don't have all of the people that they need to operate the stores efficiently, that is how they are achieving this operating margin improvement and the reduction in the cost of revenue. The other area of improvement that GameStop had here on the income statement is in pink here, the operating expenses, or the SG&A, $296 million. As a percentage of the net sales for GameStop, that was about 27.5%, a marked improvement from the same quarter a year ago, where the operating expenses were about 32.7% of net sales. In the 10Q, GameStop tells us that this improvement in the SG&A is attributable to a reduction in labor-related consulting service costs and marketing cost of $70 million, driven by their continued focus on cost reduction efforts. Also, store-related costs decreased $8.5 million in the current year in connection with store closures, primarily in the European segment. Bottom line, operating income came in at negative $14 million. We get to add in the interest income that GameStop earned, giving them a net income of negative $3.1 million, earnings per share minus 1 penny. Moving over to the balance sheet, I think it's fair to say there is nothing not to like on GameStop's balance sheet. Cash and cash equivalents coming in at $1.2 billion. And when we look at working capital, the total current assets are $2.37 billion versus total current liabilities of $1.4 billion. Going down to the very bottom here, shareholders' equity positive $1.2 billion. Looking at a summary of the cash flow statement, the 9 months of 2023 so far, cash used in operating activities, $192 million, cash used by investing activities, $53.8, and cash used and financing activities $8.1 million for a net decrease in cash for the 9 months so far in 2023 of $266 million. As they tell us in the footnotes right below the table, the bulk of that cash used in operating activities went towards inventory. The investing activities, that cash used went towards the purchase of marketable securities. And on the financing activities, the cash used was attributable to repayments of government guaranteed low interest French term loans due through October 2026. As I said, there is a lot to like in these financial statements, and they did beat analyst estimates for their earnings per share, coming in at only -1 penny versus expectations of -8 cents. Let's talk about what I'm concerned about though, and we're going to start off with the top line revenue. The industry and GameStop is still experiencing a decline, and you can see from the chart here that the top line revenue from GameStop is continuing to trend down, and that also has something to do with the fact that they continue to close stores, a necessary step to get costs under control, get rid of that dead weight. But it is something that analysts and Wall Street is looking at because you're operating a business where the top line revenue is declining. That's something you need to pay attention to. The other thing that we have to look at is a very long history going all the way back to 2017 of negative net quarterly earnings, although we expect that to change in Q4. So good news there. And hopefully into 2024, if GameStop can keep these controls in place that they have, they can start posting some positive net earnings. We do expect in Q4 2023, GameStop is going to get that big bump up in quarterly top line revenue and a positive net earnings for Q4, potentially, probably giving them a complete year of positive earnings for 2023. And that is another hat tip to the ruthless cost cutting measures that GameStop has put in place. I am also keeping a close eye on GameStop's cash and cash equivalents balance. It's dropped about $500 million from 2021, where it was at $1.7 billion. Now at $1.2 billion, although you can see from the chart here, they have leveled that out. They've stopped the bleeding, and that is great news for GameStop investors. A very quick look at the dashboard, which gives you a pictorial analysis of the risk of holding GameStop over the long term. What we want to see on these dashboards is nothing but green boxes. So let's talk about the red ones and what changed from last quarter. Well, there was one box that changed, the earnings per share momentum, the second one on the top. That one flipped green. They are making some headway there, and that is great news. The company is still not profitable, although I expect next quarter we will be able to flip that top left box green, another green box for GameStop. Return on equity, still a red box, -1%, but a big improvement from last quarter. That one could very well turn green in Q4 as well. Revenue growth rate, -9% year over year. Remember that chart where we showed the top line revenue declining? Your best investments are going to be ones where your top line revenue is growing every quarter, not one where you're investing in a company with the top line revenue declining. That indicates a problem. There is still a red box, and I'm going to keep there for a couple quarters on the CEO and management due to the recent resignations and firing of the CFO and the CEO. We will have to see how Ryan Cohen does in his new position. And the short interest, the last red box, 23.96% according to Ortex. These shorts are still believing that this stock is going down, and they are not getting out of the way. They are fighting the bulls, and they are still heavily shorting this stock. So let's talk about why is that happening. There is a reason why I have a $10 short-term price target on GameStop. The same reason the analysts have a $6 price target on GameStop, and that is why these shorts are still in this play. Now, is there going to be volatility? Could a short squeeze happen where people pile in, some good news happens that no one's expecting, you get a FOMO run, and we squeeze some of those shorts out of GameStop? Absolutely. Anything can happen, guys. But if that does not happen, let's just talk about the financials and the valuation of GameStop and why the shorts are invested in this play and shorting this ticker. The most bullish bulls are going to tell you, just look at the balance sheet. This is a slam dunk. I would urge you to look at more than the balance sheet, because I assure you that Wall Street certainly is. A company is not evaluated on its balance sheet alone. And that top line revenue declining and the lack of earnings is what people are focusing on for GameStop, and the fact that the management has been very quiet and not communicated any significant transformational plan for the company. Now that could change at the drop of a hat, right? All we need is some sort of announcement from Ryan Cohen or GameStop, and we have a whole new ball game. But right now, as far as an investor, you're either going to be speculating on the chance that that happens, or you're going to be making financial decisions, investment decisions based on what you know at the moment. And that is really your choice to decide how to participate in this play. For me, it was a tough decision, but as I've said in other tickers, everything changed after 2021 ended and we entered a new economic cycle with rising interest rates and inflation. And I did change my trading plan for GameStop around the time they did that split, sold my GameStop into this run up, and I have only been holding it for short periods, trying to buy the dips and sell into the rips. I have been making money on GameStop. I have not participated in every dip and rip because I missed some of the dips. I was hoping it would go a little bit lower and I'd get a better buy in, and then it ripped up and I just missed it. But overall, I've been very successfully trading GameStop for a profit since August of last year. That is just my trading style. It doesn't mean that it's right for everybody, and certainly you do the way that you want to do for your own portfolio. I have my own DD, and that DD is based on the financials and the trajectory of top line revenues. The other thing that you hear people talk about is the book value per share on GameStop. It is $4.14 per share. How do we get that number? That is the total assets on the balance sheet minus the total liabilities on the balance sheet. That gives us the shareholders' equity of $1.26 billion. We divide that by the number of common shares outstanding, and you get your book value per share, $4.14. Some people will tell you that based on that number alone, this stock is greatly undervalued. I would point out to you guys, back when Roaring Kitty was looking at this stock in 2020, the reason that it caught his interest is that the book value per share was actually higher than the price that GameStop was trading at. That is an undervalued stock. When your share price out on the market is lower than the book value, that's a screaming potential good deal, and that's what caught his interest. In this case, we have a book value per share of $4.14, but it's trading out on the market at $15, a considerable multiplier higher than $4.14, and I really question anybody who says that it is undervalued based on $4.14 book value per share and $15 out on the secondary market. Another way that we might try and back into what is a valuation for GameStop is to look at potential future earnings. And analysts are predicting for 2024 a high earnings estimate of 14 cents for GameStop. Let's just triple that for our example. Let's just assume that those analysts have no clue what they're talking about. They're way too bearish. Let's triple the projected earnings for 2024 and say it's going to be 42 cents. And then let's assign a very generous PE ratio of 25. And what price does that get us for GameStop in 2024? About $10.50. So I hope you can see how I'm coming to my price target for GameStop. This is the valuation model that I'm using. Will I be right? Heck, I don't know. And could there be volatility in the meantime? Absolutely. But I do think it's important that you understand how Wall Street is coming up with their price targets so that you say, well, there's no way that could be right. There is a way that it could be right if they're using traditional financial analysis and if they are correct that no meaningful transformation is coming from GameStop. So ultimately, guys, as retail investors, if we want to see this price get a major bump up, price targets get a major bump up, we need to see either more earnings, more than 42 cents per share on an annual basis, or we need to see some transformation in the company. And I hope that we hear something soon from Ryan Cohen. I said that in this video I would talk briefly about Ryan Cohen and the board's approval for him to trade the company's cash on equities. And I'm not going to throw a big old bucket of wet water on that like many people are. Hey, Ryan Cohen has shown himself to be a pretty smart trader, so maybe he will do something positive for shareholders with that money. It does have inherent risks. So I'm just going to say, Ryan, show us what you can do. and I will certainly applaud it if he's able to make money for shareholders doing that, and I will call him out if he fails. I did have the same question before the analyst even spoke up. The next day, I said to myself, if GameStop is the best investment out there on the market, like some people are telling us, why wouldn't Ryan Cohen just go buy GameStop stock and retire those shares, right? There's a couple things that a company can do with cash when they have $1 billion sitting out there. They can use that money to acquire other companies and expand the business, increasing shareholder value that way. Or they could buy back shares, which also increases shareholder value by reducing the float. And if you think your stock is the best thing going out there and that those shares are undervalued, then you should buy back GameStop stock, Ryan Cohen. But apparently he thinks that he can do even better by investing elsewhere. So I will have to say, hey, Ryan, I wish you all the best, and we will track his progress. The final thing that I want to talk with you about today is the S&P 500. It is a hotbed of discussion on Twitter and Reddit. I don't think that there is a chance anytime soon that GameStop is going to be considered for the S&P 500, and let me walk you through why. In July of 2023, they updated the market cap requirements to be considered for the S&P 500 to a minimum market cap of $14.5 billion. And there will be way more than 500 companies that have a market cap higher than $14.5 billion. Not all of them are going to make it, but GameStop would need a price close to $50 per share to even meet this minimum hurdle. So for all the discussion about is it going to have a profitable fourth quarter or a profitable 2023? It's just simply not going to matter because they're going to fail to meet the $14.5 billion market cap requirement. That is all I got for you on this video. Leave me your comments or questions down below as long as they are sane, civil, and you can speak like an adult. I'm happy to answer any questions. There is certainly no requirement that you ever agree with anything that I say. Just be an adult about it. I am Tony Denaro. Have a great trading week, and I will see you on the next video.